Welcome to this week's episode of DoubleLine Minutes. I'm Jeff Mayberry with Sam Lau.
Hey.
It's 10:05 Pacific time here, September 13th. We started a little bit late because we're running through some numbers real quick, and we'll get into the exact details of that very shortly. I guess, Sam, let's try to keep it tight here today and get right into the where are we for the week.
All right. And where we are is a pretty good week for across all markets here I'm looking at. Up about 4% on the week-to-date basis for the S&P 500. When I'm looking at it for a year-to-date, that puts us up into the 19 handle thus far at this point of this recording for the year-to-date performance. Leading the way right now is the old familiar technology. It's been missing for a little while in terms of the leader of the pack, but right now I have it up almost 8% on the week-to-date basis. The next best performer is consumer discretionary. That's up 5.5%. And it looks like we, as of right now, if we're going to be precise, which we should, we have about 10 sectors in the green right now. It looks like energy is trying to decide if it wants to end the week on a positive or negative note right there. It's down about just under 10 basis points right now, negative for the week to date basis. Looking across the other the small versus the large cap for the U.S. equity market, Russell 1000 in the Russell 2000 are up both about 4% between for this week. So pretty much in line with each other for the week-to-date basis. But when we take a look at the growth versus value indices, Russell 1000 growth trouncing the Russell 1000 value by 4 percentage points. The Russell growth is up 6% on the week-to-date basis, so outperforming the S&P 500 as well. Moving over to the fixed income side, in Treasury land, right now we have a yield on the 2-year note of 3.57, and that's relative to a 10-year Treasury yield of 3.65. And then on the bond, we have a yield of 3.98. So a little bit of rally across the yield curve for this week, all in about somewhere around 6 basis points lower in yields across the curve there. When I take a look at the inversion between the 2-year and the 10-year, which was the topic of the week last week for the minutes. If you missed that episode, you can go ahead and pick it up on your favorite podcast platform or on the DoubleLine.com website under the podcast. But we spent some time talking about using the curve inversions as a predictor of recession. It looks like we did make that 5 consecutive trading days of having a uninverted curve, and that's where we sit today at 7 basis points positive between the spread on the 10-year versus the 2-year note there. So what that means is it looks like our recession signal has been triggered, and if memory serves, it's on average, it looks like it's about 5 months out from the point of that signal being triggered there. So if that's the case this time around, if we're going to line up right on average, that should put the start of the recession somewhere in the first quarter of 2025 in the month of February. So with that, we'll keep an eye on that, of course. But moving over to what that meant for the broader fixed income complex, using the Bloomberg U.S. bond aggregate as the gauge. On a week-to-date basis, we have a positive 60 basis points for the egg, and that puts the year-to-date just over 5% now on the performance for the year on the egg. Leading the charge this week is the EM market. That's up about 1.25 points. Clean sweep, though, for positive numbers across positive performance for the cohort that we look at. The worst performer being the bank loans and Treasury market, both up about 40 basis points. On the year-to-date basis, I see, and pretty much all the windows of time that we look at here, the month-to-date, quarter-to-date, as well as the year-to-date, all positive across each one of these cohorts. So very strong years, to start year so far for the bond market. Moving over to commodities finally caught a break here with a positive week. It's up 2.8% as measured by the Bloomberg Commodity Index, putting it back in the positive territory by just over 1% on the year-to-date basis. Looking at some of the individual commodity futures here, the front month future contract for WTI crude oil is in the 69 handle right now at 69.25 for the one barrel of WTI crude front month oil futures there. On the week-to-date basis, that was up just over 2.25%. still negative on the year by about 3%. Gold looks like continues to push higher into new highs. Right now, it's trading at $2,587 and some change for a troy ounce of gold on that front month future. That puts it up about 3.5% on the week and just shy of 25% positive performance on the year-to-date basis. So gold definitely sniffing out this potential for a rate cut coming soon around the corner. So with that, Jeff, do you want to kick us off on what happened in the macro front?
Yeah, we had it was inflation week this week, and on Wednesday we got CPI. The CPI month over month for August came in at 0.2%, right on expectations there. Actually, the core CPI surprised a little bit to the upside, came in at 0.3 versus the 0.2 expectations. That brought the year-over-year CPI to 2.5 and the core CPI to 3.2. Really looking at the drop in the headline CPI was really due to we had a big roll off from last year, and also had energy being negative, especially as we talked about in the stock market. That also helps. That's helpful for headline CPI, but that's really why the core CPI didn't really have that same negative effect here either. We did get the PPI number on Thursday. That came in. PPI final demand for August came in at 0.2, slightly above the 0.1 expectations. Ex food and energy came in at 0.3. Again, was expected to be 0.2 there. So slightly above estimates there from the PPI side of things. The final demand year over year was 1.7, right in line with expectations, and ex food and energy at 2.4. So not too crazy. Really, when we looked at it, or after those numbers came out, we can give a pretty good estimate of where the PCE comes in. That's obviously the Fed's preferred inflation gauge. So once we got those components in, that implies a 0.18 month over month number for core PCE. That would bring a 2.7 core PCE for that. That's the estimate. So getting pretty close to in line with what the Fed wants. We are in the kind of best part of the seasonals, though. So those are the people that are looking at the shorter term annualized numbers. This is where they get the idea that inflation is coming down, that the Fed needs to cut rates because inflation is under control. But really, when you look at it, this is from a seasonality effect. This is last year when people got excited about Fed rate cuts again, and that obviously didn't pan out. So it'll be interesting to see how this shakes out over the next couple of months. But this is really the last big step for the Fed to become comfortable with rate cuts coming next week. We also got the jobless claims numbers on Thursday. Initial jobless claims came in at 230,000, just slightly above expectations of 226. Continuing claims 1.85 million, exactly on the nose with the estimates. So steady as she goes there. Nothing really to see here from the jobless claims numbers, but we'll keep looking at it. We also got import prices this morning. Month over month for August came in at negative 0.3, so slightly below expectations of a negative 0.2. Ex-petroleum came in at negative 0.1, so a little bit of deflation there versus a positive 0.2 expectation. The year-over-year number then is 0.8%. And then finally this morning, we did get the University of Michigan 5 to 10-year inflation expectations. Came in at 3.1, was expected to be 3.0. To me, that's just noise, so nothing really to worry about there. Not really out of line and getting unanchored, as Jay Powell would like to say. Finally, from a Fed speak, because of the Fed meeting next week, it is a blackout period, so we didn't get any Fed speak. But it was interesting. If you looked at the interest rate probability chart yesterday morning, you look at it and it was looking at about a 10 to 20% chance of a 50 basis point Fed rate cut next week. And then our favorite blackout person to watch during the blackout is Nick Timiraos. And he came out with a story, not saying that the Fed is going to cut 50, but that's a closer call than people were expecting. So the market had been pretty much after inflation priced in a 25 basis point rate cut. But now that Nick Timiraos says it's a bigger question, market's pricing in a 50% chance of a rate cut. So a pretty big move there. It'll remain to be seen kind of what the Fed does from here. You can still see that Wall Street is a lot of Wall Street is still calling for 50 because that's what they want. They can make the case for that, but from my perspective, I still feel like 25 is the way the Fed's going to go. They're going to take their time, but we'll keep an eye on what Nick Timiraos says early next week, because that'll be the kind of the signal for what the Fed is likely to do. They don't really like to surprise the markets very much.
Yeah, it's always interesting to when you hear it's like the old commercial when E.F. Hutton speaks, everyone listens. It's when Nicky Timiraos speaks, everyone listens here on Cues for the Fed.
Yep. And with that, I mean, we can get into the topic of the week. And I don't know when we got this question and our social media guys out, so I can't ask him, but he did get a question. We did get a question on the X asking about how many rate cuts are implied by market prices for treasuries. Are they a reliable indicator for in a rate cutting cycle? And kind of his secondary question is are they being impacted by other factors such as liquidity, psychology, hedging, etc.? Curious to hear our thoughts. And he says he really enjoys the podcast, or he or she says they really enjoy the podcast. So thank you for listening. And Sam, we have some very quick thoughts on this topic.
Yeah, and that's right. Thanks again for Recovery Trade for sending in that question. Longtime listener there, and always a good source of topic of the week subjects for us or topics for us here. So, with that, in terms of talking about the 2-year or the treasuries as being a reliable indicator for Fed rate policy, this is something that Jeffrey Gundlach has long said that the FOMC could just be replaced. All of the several hundred of PhDs over there can just be replaced as well, but just use the 2-year Treasury instead to set policy rate. And the reason why he said this for so many years is that the 2-year yield does tend to look to be a good leading indicator for the direction of what future Fed rate policy will be. When you take a look at the yield level on the 2-year, it's not always a great indicator in terms of how high or low the FOMC will take that target rate. But if you look at the bills or the shorter end of the curve there, they tend to be a little bit better in terms of the magnitude of the actual hikes or cuts there. But when you look at the 3-month T-bill, it does get the level quite a bit better. It tends to be more of a coincident indicator that the 2 years leading indicator for the timing of changes in rate policy. And really what you can, we don't have visual here on our audio podcast, but we'll go ahead and try to put up remember to put up a chart on our X page of this so people can take a look at it. But when you take a look at this, an overlay of the historical treasury yields, again, using your yield of choice, but the one that Gundlach likes to look at is the 2-year, but perhaps we'll throw up a 3-month bill yield on there as well. But if you overlay those yields historically with a chart of the Fed funds target rate, you'll see what we're talking about here. But pretty good indicators for the directionality, both of them for the Fed rate cut or hikes. Cuts in this next cycle here. But when we take a look at the current cycle, the 2-year yield started moving lower in, it looks like about May of this year. And if we get to September cut, so that's about 4 months ahead of schedule, but it gives us, again, that leading indicator there. And it's sort of triple topped with peaks in the yield looking at around March and October of last year. All of these 3 peaks, these triple tops were kind of in the low 5 handle type of yield there. So the 2-year never quite got to the target rate or the target on the upper bound, or even or maybe it got to the lower bound here at about 5.25 or so, but it was lower than the target bound, range bound for the Fed policy rate, and it was also lower than the effective fund rate during that period of time. But if you take a look at the 3-month yield, that's been trending lower since about July of this year, it looks like, and at its cycle high, it looks like it just kissed that upper bound of the Fed funds target rate at 5.5%. So with it, if we look at the other side of the cycle, that's looks like, as we're about to embark on the first rate cut, if we look at the other side, when the Fed started moving rates up, the 2-year started pricing in a hike in September of 2021 here, and the 3-month yield didn't start moving until January of 2022. And if you recall, the first rate hike there was March of 2022, the first hike in this cycle there. So the 3-month just giving us moving ahead just only by about 2 months ahead of that. So much better coincident, or not quite coincident, a bit of a leading indicator as well, but it is tends to be closer to than the 2-year yield there, and I guess that's to be expected given the 2 years is the annualized yield, for over a 2-year period. So with that, you're getting a little bit farther look in the future. But overall, again, we'll for those who are listening to this, be sure to check out our X page, and we'll go ahead and put up a chart to show that, so you can just kind of see what we're talking about here.
Yeah, and when I last week when I was running
Jeff, I think you had some comments there. It looks like you put in the notes here.
Yep.
You took a look at the 2-year versus the Fed fund futures.
Yeah, instead of just taking whatever can look a more backwards looking approach, taking the current 2-year and taking the implied rate from the Fed funds futures curve and just kind of backing into it. And if you could kind of lock in these rates on Fed funds futures and map it out for the next, I think there's 6 meetings a year, so you have like 12 meetings that you have to cover in these Fed funds futures. Kind of compounding and being able to put it all together, you come up with a pretty similar rate to the 2-year rate, as you would expect, given kind of arbitrage opportunities. There shouldn't be too much of a difference there. I did look at it, and the 2-year Treasury was trading slightly below what the compounded Fed funds futures rate would be. I think that that's one of the things that Recovery Trade highlighted, is that liquidity, and I think the 2-year is much more liquid than the Fed funds futures, and especially if you're kind of compounding that over time. One thing with the Fed funds futures, though, you do have some optionality of if things get faster or slower. If you were kind of just going to roll those Fed funds futures every meeting, you could obviously change your mind, change your course. But obviously, if you're buying the 2-year, you're kind of locking in that rate for the next 2 years. So I guess there's no better way to do it, or there's no better investment depending on what you want to do. But from our perspective, obviously the 2-year with that liquidity is definitely a much easier way to either underweight the 2-year if you think that the Fed's going to be slower than the market's pricing, or if you think the market pricing is correct, or Fed's going to go faster. We're going to get a recession, then the Fed would cut rates even more aggressively. Then maybe you want to be buying or overweighting the 2-year. But Sam, as you said, they move pretty much in lockstep, and so there's not too much of a opportunity there from that side of things.
Yeah, so hopefully Recovery Trade, if you're listening to this on the Twitter Spaces, or the X Spaces, I guess it's called, hopefully you found that useful, or hopefully you catch it on the recording. But with that, in terms of things to keep an eye out for, next, I believe it is, 9/17. So it's next Tuesday, the day before the FOMC meeting. We have the final pretty major data point, I suppose, prior to or before the meeting. So with that, we'll have the retail sales coming out, and the advance number on the month over month looks to be a negative print of 20 basis points for the month of August, and that's coming down from a positive 1% the month prior. And then if we take a look at the retail sales ex auto month over month, that's expected to be a positive 20 basis points. And then when you strip out gas on top of that, then that's expected to be a positive 30 basis points on that component. The retail sales control group is which is the component that gets fed into the personal consumption expenditures for the calculation of GDP. That's expected to be flat versus the previous period at a positive 30 basis points there.
And Mark and Eric have a note in here that says that if you remember, there was the cyber attack on the car dealers, I think in June. And so the July was a big rebound. That's why the July retail sales was a positive 1%. And so it's expected to kind of decrease from there to negative 0.2. But I think that's why that ex autos and gas number is kind of where we want to kind of keep our eye on, because of the volatility in that headline number.
Yes, that's right. And then on the 18th, on Wednesday, we'll have, of course, the FOMC. Where they're based on the survey that we're getting from Bloomberg, it looks like it's expecting for a quarter point cut to put the upper bound at 5.25. And then, of course, as Jeff mentioned earlier, it's pretty much what the Fed fund futures are pricing out. It's pretty much a coin flip between the 25 and the 50 basis point cut. So we'll see what shakes out there. And then finally on Thursday, we'll have the initial jobless claims data and the continuing claims. We'll continue to watch to see if there's anything that pops out there. Haven't really seen any aberrations of late, so it may be steady as she drifts on that. And then also on Thursday, we'll have the leading economic index coming out as well. So that's also expected to remain in negative territory there.
Yep, I think that wraps it up for this week. I'd like to remind everyone that Jeffrey Dunlop will be on CNBC on Wednesday, for Fed Day, live in our LA office. And then also after the close, Ken Shinoda will be on Bloomberg TV. Both of them obviously talking about the Fed. We'll see what their thoughts are on how well Jay and Co have done things and whether we get that 25 or 50 and whether they think was the right move given the circumstances.
Yeah, and definitely want to thank all of our listeners out there for checking us out, be it on the spaces or on the recorded version of DL Minutes. Don't forget, you can hit us up like Recovery Trade did on the X at DLine Minutes, or you can send us an email at minutes@doubleline.com if you have any questions, comments, or suggestions for the future topic of the week.
And our YouTube channel is youtube.com/DoubleLine Capital. If you don't catch the spaces re-airing or whatever it's called, you can catch us also on our YouTube channel. So it looks like a lot of people are doing it there. And I'd like to thank everyone for tuning in and hope everyone has a great weekend.
Yeah, thanks everyone, and good luck out there.